Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And don't forget it.
Welcome to another edition of Talk Money. My name is Jeffrey Shank. I will be your host today. I am the owner of Andover Advisory Group, a registered investment advisor. I'm also a chartered financial consultant. And we do the show once a week to give you some tips, some updates on tax rules and things that are happening regarding your personal finances. And ultimately, our goal here is to raise your money IQ. So if we've added a few points, then we have accomplished our goal. Good morning, Lou. How are you?
I'm doing very well.
Hey, I was going to say you're unmasked host, but I didn't want to
upset people.
Think that I really don't care. But I don't know about you, but I've been venturing out into the real world and doing some shopping.
Yep.
Non-grocery.
No, you
non-grocery
don't go in the grocery store. By the way, there's a big grocery store news front.
Is there?
Yeah.
I hadn't heard. What?
Yeah, I went to the Market Basket in Newburyport last night,
yes.
And they had taken the one-way stickers off the roads.
Okay, well, so that's exactly what I was going to talk about. So I was in various hardware stores, the big box stores, and walked in with, dutifully wearing my mask.
Yep.
And looked around, and even the associates were not wearing
maskless.
We're not wearing masks. Now, I'm in New Hampshire.
Yep.
And every store I visited was also in New Hampshire. But it varied by location.
I can imagine.
Because in one town, there was a little bit more compliance or more masks being worn than.
Well, that's not compliance anymore, right? There's no mask.
I don't know. It was a story in New Hampshire.
I don't believe there's a mask.
I think the governor came out right after the CDC released if you've been vaccinated, don't have to wear a mask.
Yep.
Follow the science.
Yes. Follow the science.
Follow the science.
To which Governor Baker said, let's not follow the science.
So I'm not sure what happened in Massachusetts, but in New Hampshire, the governor said, yeah, well, we understand, but we're going to leave it up to the local communities to make their own decision. But we still think it's a good idea if you wear a mask, at least for now. So
Governor Baker said he was going to think about it a while.
Oh, he did?
Yeah, he's not following the science anymore.
Right?
Only when it's convenient.
Am I right? I mean, I thought about that the other day.
This is the science, right?
You wear the mask because the science says you should wear the mask, right?
So I went to my son's commencement.
Yes. How did it go?
At UVM.
Yes.
And
you signed off. You signed off saying that you.
I did the attestment, right?
Yes.
And I don't want to out UVM, but they didn't even ask
to
see the vaccination card, and we all thought it was a bluff anyway. But you've got a bunch of people here who are theoretically fully vaccinated.
Right.
Certainly most of the people in the crowd, I was a week short of fully vaccinated.
Yeah.
And we're outdoors on the lacrosse field, which is AstroTurf in 85-degree heat.
Oh,
it's brutal.
Yeah.
And they've still got pairs of chairs and single rows of chairs separated by 6 feet. And it's like, Aiden's mom said, well, they probably did these plans a month ago or 2 months ago to get them approved, and it was a different world back then.
Okay, yeah.
It was a little over the top, I thought.
Yeah. So
especially considering it's a qualified audience, everybody is fully vaccinated, in theory.
So after about 6 months of mask wearing and social distancing, I predicted that for some, the wearing the mask was going to become a more permanent
Sure.
way of life.
And I understand why some businesses would continue that policy, because a restaurant gets a positive among the staff, for example, they're shut down. Right? They're going to have to shut down. So restaurants will take some caution among their staff and things like that in certain businesses. And again, if a private business wants to do it, fine.
Right.
We can all make a choice whether to go along with them or not and do business with them.
Right.
But yeah, I think masks are going to be around for a while, but hopefully it's going to be
because people are going to feel safer.
Yeah.
Wearing it. And I guess I just want to say that I don't have any
no.
For me, it's not a political issue. I think it's a health issue, and you wear it because you think it's a smart thing to do. And the various health agencies and public officials mandate it because, again, they think it's a health issue. It unfortunately became a left versus right.
Well, I mean,
symbol, left versus right symbol. During the pandemic, which I think was dumb, because if you wore it, then you were a lefty. If you didn't wear it, you were a righty, which makes absolutely no sense.
I wore it, and I wore it because I wanted to get along.
Yeah,
with people. I didn't wear it because I thought it was particularly effective or smart.
To conform. To conform, and
I wanted to go places,
and
I didn't want any hassle,
and to be part of society.
So I put the mask on.
Right.
Yeah. By the way, same way. I got the same reason I got the vaccination. Not necessarily for the vaccination so much as to say I've got to participate in this world.
Yeah. Right. Yeah. And to say that you have it, have done it.
Exactly.
Right. Yeah. I mean, great point. And but that's a great thing about this country.
Yeah.
Right. We can all make our individual decisions and come up with our own reasoning for the actions that we take.
And listen, I'm a spiritual guy now. I've raised my level of enlightenment. Totally. So I'm not going to go back and relitigate this whole thing. Other than to say Massachusetts is one of the strictest states in the nation and still is one of the hot spots in the nation. So I'm not sure how effective the whole process was. Yeah.
Good point.
Yeah.
Hey, so I've got a great show lined up today. I think we're gonna talk a little bit about the pros and cons of rolling over your company retirement plan, and then I get asked this question a lot about gifting. So parents will say, I'm thinking about making some gifts now to my kids. I've got more than I need. They're going to inherit it someday anyway. And plus they're thinking about buying a house. I might help them with a down payment or something like that. Mm-hmm. What are the income tax consequences? Because I think we've become conditioned to fear the IRS.
Yes.
Right. And if you give somebody money, the expectation is that somehow that's going to raise some eyebrows, and it's going to be treated as income to the person who's receiving it, and that's probably the first myth that I want to dispel today. But I want to talk a little bit about gifting, substantial gifts. Now, we're not talking about the $100 check you throw in the birthday card,
sure,
but substantial gifts to your children, and what are the things to consider when making those gifts, and for this week's Talk Money tip as well. So let's get started with the pros and cons of rolling over your company retirement plan. I do have a screen to share with you.
There you go.
A slide to share. Mm-hmm. And these are the top reasons why people have recently rolled over their IRA. So I thought I'd go over that first, just to kind of put this into perspective. And so the top reason why people decided to roll over their IRA was because they didn't want to leave the assets with their former employer.
Was this a New England poll? Because it sounds like us.
I got to tell you, I get that a lot. Yeah. When we're discussing the benefits of rolling over, the benefits of keeping it with your former employer, or they in many cases they fear what might happen to their money if they leave it with their former employer. What were you thinking?
I was thinking, I just don't want the guys. I don't want them to have it.
Yeah, same
like
thing.
They're getting a benefit out of it or something.
Right, exactly. Same thing.
Yeah.
So they have an animosity toward their former employer, and so they figure if they take it out, that's hurting them.
But the employer has no control over those funds. Right?
Generally speaking, if it's your money, it's 100% vested, and you can roll it over. Really, there's nothing that the company can do with it. There's really no benefit to the company for leaving it there. However, the custodian, the firm or institution that is custodying your assets, that's holding onto your assets, they're actually benefiting, which may have nothing to do, and in most cases has very little to do with your former employer.
What happens if the company goes down?
Well, I guess that's my point.
Yeah.
So you're 100% vested, and those monies are kept in a separate account, custodied by a third party who has nothing to do with that. With that.
So those
company.
funds aren't mingling with the company's finances.
In almost every case, there are rare exceptions, but I'm talking about the 401k plan that you've been putting money into, and the company's been matching. Your monies are 100% vested. They can't hang on to that, and it can't be reached by the company's creditors. And the company match, if it's 100% vested, it's yours. You can walk away with it. Okay. So 69% didn't want to leave the assets with their former employer.
Right.
65% wanted to preserve tax treatment of the savings. 57% wanted to consolidate their assets. I talked to a lot of people who say, hey, I've had 4 different jobs, 4 different 401ks, and guess what? They've still got 4 different accounts with all of them.
Yep.
55% wanted more investment options, and 44% were actually required by their former employer to take the money out. So a lot of companies, especially small companies, they don't want the responsibility of having the fiduciary responsibility of having your assets as part of the plan. So built into the plan is a rule that says if you leave within a certain amount of time, you have to take that money out.
Because I'm guessing they pay fees to the people who are handling it, and it's probably based on the size of the people enrolled. And
that is part of it, but it's more just the potential for something to go wrong. Yeah. So if you're not going to be part of the company, they'd rather you take your money elsewhere.
That sounds very New
England
too.
They don't have to worry about it. It may be. We'll have to see what the geographic. So there's a lot of reasons why you might want to roll over your funds, and we listed some of the reasons that people were thinking about. Some of them made sense, some of them didn't. But one reason what might be you want to consolidate your assets into a single, because that might give you more control. It might give you a break on the cost of managing that money, right? And it might actually give you more visibility, because a lot of times this money is out there with different custodians, and you might get a quarterly statement on one. You might not get a statement except for once a year on others, or some are sending electronic statements, and you've changed your email address 3 times, and you're not even getting those electronic statements anymore, right? And rolling over those funds into, and I should say specifically into an IRA, an individual retirement account that you're controlling. Typically, you're going to have many more investment options available to you. So with a 401k, usually there's going to be a limited menu of investment choices, and that potentially limits your ability to properly diversify your overall portfolio and may have a negative impact on performance. Although in most 401k plans, those fees that are associated with investment management typically are reduced, especially if you're dealing with a major company that's got a lot of plan assets, because everybody's competing. All those institutions are competing for those assets, so they want to keep the fees as competitive as possible. And your employer actually has a fiduciary responsibility to make sure that they're doing their part to minimize the overall cost associated with the plan. Otherwise, they can be held liable for not meeting their fiduciary obligation to the participants in the overall plan. But there's a lot of reasons why you might want to keep the assets with your former employer.
Okay.
One of those reasons is that most 401k retirement plans have a provision that allows you to access the funds as early as age 55. So, when you have an IRA, we talk about it a lot.
Right.
The magic age is 59 and a half. So 55 is 4.5 years earlier
Right.
than a typical IRA without having to pay a penalty. I should mention that. So the difference between...
So that can be an individual choice of the issuer of the 401k.
Yeah, but I get it. It has almost become standard.
Okay.
In most company retirement programs, 401k plans.
Yep.
That because it's available, and so most employers want to be as liberal as possible,
right?
So that you can access your money without taking a big hit. I mean, why would they? Why would they make it more stringent if they didn't have to?
I see it from the employer standpoint. I'm just wondering I was wondering that the IRS recognized it, that you could take it out at 55 without paying a penalty.
So that's been a provision of plans as long as I can remember. Going back to the defined benefit days where you could take your retirement benefits as early as age 55 if you had adequate service. So there's a lot of history.
Okay.
But we know that with IRAs, that's not true. And again, we're talking about pulling the money out without paying a penalty, a 10% excise tax, essentially,
right,
on those distributions for early premature distributions. So what if you get laid off and you don't have that next job?
Right.
And you might need some money in the short term. Well, once you roll it over into your IRA, you're subject to the IRA rules. You no longer have the opportunity to pull money out at age 55. So you're leaving it in a fund that you have quicker access to if you need it. Gives you an option.
Obviously,
depending on your age. Again, these are the individual circumstances that should be considered before rolling it over. And let me just stop and say that, unfortunately, in a lot of cases, the reason why people roll over their 401k plan is because they were advised to by their financial advisor. And you have to keep in mind that your financial advisor isn't making any money while you're keeping your money in the 401k.
Right.
But does have an incentive to have that money rolled over. And so you want to be very careful that the advice that you're getting is
in your best interest.
Right.
Yeah.
Yeah. And in fact, there's been a lot of rules that have been created around this whole subject of rolling over your retirement assets to an individual retirement account, because unfortunately, again, a lot of advisors have provided what might be considered bad advice, because again, they it's in their best interest to see you roll over that money, right? Another reason why you might want to leave it in the company's retirement plan, because it might be easier to move it from your prior employer to your new employer, because the rollover rules have become very liberalized, and you can just take your 401k program and move it, or your 401k balance, and move it to your new employer's 401k plan, even if you're not eligible to start making contributions to the 401k. A lot of people don't realize that. They think they have to be eligible to participate in the plan by meeting the eligibility rules, the service limitation, before they start making voluntary salary deferrals. But the fact is that if you're rolling over money, that doesn't matter. As long as you're employed, you can set up an account and you can roll that money in before you're eligible to participate in the plan. And why would you do that instead of rolling it over to an IRA? Well, you would do that maybe because the H-55 rule again. So your new employer has the same ability to pull that money out without penalty, and you have the ability to take loans against your 401k. Yeah. Where you can't do that against an IRA. A lot of people ask me about that. No, I just want to borrow some money from my 401k. My IRA. Yeah. And the fact is that you cannot borrow against an IRA or otherwise use it as collateral for a loan unless you're willing to accept recognition of the entire balance of that account.
What does that mean?
As a distribution.
Oh, okay. Which you don't want to do.
It's a deemed distribution.
Yeah.
So as soon as you borrow against your IRA, it's considered a deemed distribution of the entire balance.
And that's a taxable event.
And that would be a taxable event. Yeah. And quite possibly a lot of penalties involved. Again, whereas with the 401k, you can still take loans if your new employer allows it, and typically 401k plans do allow loan privileges, and that would include any money that you've rolled into it from another plan as well. Hey, another reason why you might want to. So some plans, I see this happen too. So some plans allow for in-service distributions. Again, age 55, once you reach a certain age. Right. So you're still working. Yep. But you're allowed to make in-service distributions. And so I've seen a lot of cases where people are advised to start making those in-service distributions, which can make sense in some cases. And they roll those in-service distributions over to an IRA account. Well, the problem with that is that if you're reaching that magic age of now 72, where you're required to start taking money out of your retirement account, right? If you are still working for someone and you have a 401k with that employer, your mandatory minimum distributions are postponed. So you're 72 years old. The money in your 401k, as long as you're still working for that employer.
Interesting.
You do not have to make distributions based on your age 72.
Wow. Good workaround for the RMDs. Yeah.
Yes.
Yeah.
Yeah. So if you've rolled over that money, still working for the company, but you decided to take money out, roll it over to the IRA because somebody advised you to do it. Yep. Then you are now required to start taking money out of that RMDs out of that IRA account. Yeah. And you just made a very good point, though. Potentially a good workaround for that, because if that money is sitting in your retirement account with your employer that you're still working for, there are no RMDs on that money.
Okay, I'll be this guy. I have to ask.
Go ahead.
Is there a way to roll over monies from IRAs to 401ks?
Yes. Remember I said that the rules have been expanded for rollovers, making it much simpler to roll over money from one retirement account to another.
So you could get this age benefit, and you can get a relief from the RMDs.
Exactly.
Oh, I see.
Yeah. So many advisors are going to tell you to take your money out of your IRA that they're managing and roll it into your 401k so that you don't have to make RMDs. Yeah. How many advisors are
how many advisors?
How many advisors are going to tell you to
None.
Right, exactly.
None.
Right.
Yeah.
So
first I've heard of this.
Yeah. So you can actually take money that you've got in an IRA. You're still working, obviously. Yep. Your employer has a 401k plan. You can take money that's sitting in an IRA. You can roll it back into your company's 401k plan, and the money while it's sitting in there is not subject to the required minimum distribution rules.
So you gain up to 5 years of eligibility or access to the money, and you are bypassing RMD.
Right. Keep in mind that age 55 is a long way from age 72.
Oh, I understand. But those are two separate benefits.
Right.
Yeah.
Exactly. Yeah.
Gives you some flexibility.
Yeah. So what does it boil down to? It really depends on your individual circumstances as whether or not you really are smart to roll over your retirement, your company retirement plan to an individual retirement account. And in many cases, it can make a lot of sense. But be careful and consider the pros and the cons before you make that decision. Unfortunately, too many people make this knee-jerk decision to say, "Hey, okay, I'm just gonna roll it all over." And again, they're supported by their advisor, who is going to be setting up the account and earning a fee.
Okay, many people are self-employed to an extent. There's the possibility of a self-employed 401k. Does it also allow you? A 401k is generally more pliable in terms of investments than IRA. So could you set up something that works for you better, where you'd have more investment options?
Well, typically it's the other way around. The IRA is going to give you more investment options.
Yep.
The 401k is going to kind of limit your investment options if it is a company sponsored retirement plan for a large employer.
Right.
If we're talking about a self-employed individual, generally, if you're setting up what you're talking about is a solo 401k,
right?
Generally, a solo 401k is going to have the same investment options that an individual retirement account would have. So you're not. So in that case, you're not limited by having the 401k. In fact, it may actually be to your advantage.
Plus the ability to borrow against that money, which you don't have with the IRA.
Correct.
A third benefit.
That's exactly right.
Yeah.
Yep. Yeah, absolutely. Yeah.
Interesting.
Yeah, very good. So again, bottom line is, take a look at the benefits versus the disadvantages of the rollover before you actually make a decision. In a lot of cases too, and this is important, a lot of times when you roll it over, you roll it into something that has some sort of penalties, the product itself, not necessarily tax penalties, but the product itself has some sort of penalties for getting out of it. So you roll it into the IRA, 3 years later, you say, I shouldn't have done that, and I want to put it somewhere else.
Right.
Now all of a sudden you've got these fees or charges, back-end charges that you have to pay in order to get the money back out. So again, I'll stress it. You want to be very careful when you make that decision.
Not something you do at the kitchen table.
Nope, definitely not. All right, so we're going to take a quick break. When we come back, I want to talk about gift giving, substantial gifts to your children, and things that you should know before making those gifts. But it can be a good thing for everybody involved. So stay tuned. We'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005.
Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio. Welcome back. So I want to talk a little bit about gift giving. Not talking about charity here.
The gift you're going to give me.
Yeah.
That kind of thing.
Yeah,
Yeah.
I guess that kind of thing.
Yeah.
No, specifically gifts to your children,
Mhm.
minor or otherwise. And so I get this question a lot. People are concerned that if they give they give money to their kids, that somehow it's going to be a taxable event. They don't want them to have to pay taxes on it. They want to know what the taxes are so they can include it in the gift. They know because they've heard that you can give $15,000 and you don't have to worry about it. You don't have to report it or anything,
Right.
which is true. But they think that is a threshold that if they cross it again, will cause inclusion of that gift in their kids' income. And
Right.
that's just not true.
Okay.
The bottom line is this: here in the United States, anyway, if you get a gift, that it is not a taxable event to you as the receiver. You don't have to pay income taxes on it.
Okay.
Okay.
Yep.
Of
any size.
It doesn't matter.
Yep.
As long as it's a gift, it's considered a gift.
And here we go.
Well, if you're doing work for dad and he gives you a
I see.
gift,
I see.
then that may not pass the laugh test.
Right.
So if you're providing services and you're getting money in exchange, well, that's not considered a gift.
That's income.
Considered income.
Yeah.
Yeah. In fact, that would be earned income.
Mm-hmm.
So, and the $15,000 threshold is one that is an exclusion to the gift tax rules. And so there's a couple of other exceptions as well. So you've got the $15,000 per individual exception. And if it's a husband and wife, up to $30,000 per person. Not per family, but per person. So you can give as a husband and wife, you can give $30,000 to each of your 3 children if you wanted to.
Okay.
Every year. That's an annual exclusion,
Okay.
not a one-time exclusion. And it exempts it from the gift tax requirement that you file a return.
Okay.
That's all. And there's a separate return that you would file if you give a gift in excess of $15,000 to any one person
Mm-hmm.
in any year.
Right.
There's also other exceptions. One would be to pay for college. So anybody can pay for anybody's college. Doesn't matter how much money. Doesn't matter if it exceeds $15,000. And it is not a requirement that you file a gift tax
File a
return.
So college tuition is.
College tuition.
Yeah.
Medical payments.
Yep.
You can pay for somebody else's medical bills.
Mm-hmm.
And it's exempted from the gift tax rules as well. Support. You can pay for someone's support. And
legally ordered
No.
support or just support in general?
nope, support in general.
Yeah.
So you're buying food for somebody.
Mhm.
And or providing them shelter.
Yep.
Or paying their rent.
Yeah.
That is, and even though it exceeds $15,000 in any given year, that is still an exception to the gift tax
Okay.
rule.
This is good.
Yeah. I guess you might be wondering, well,
What falls
Cool.
outside of support?
that's a good question.
Yeah.
Well,
Support is a pretty big umbrella.
You're just putting money into an account and letting it accrue. You're giving it your
Yeah.
gifting property like stocks
Yeah. Okay. All right. Yeah.
instead of cash.
Right.
Right.
Yeah.
And the money's just sitting there growing in value. That's not necessarily support. So we're talking about direct expenses. So
Gotcha.
so the expenses are incurred. You pay those expenses, even though that the total adds up to more than $15,000. That is not considered a gift. You give your kid a down payment on the purchase of their home of $50,000. That's not considered support. That's considered a gift.
Right. Okay. Fair enough.
In fact, the mortgage company wants you to put in writing that it's a gift.
Yeah. Because they don't want to share the lien on the house.
Correct.
Yeah.
That's exactly right.
Right.
Yeah. They want to make sure that
You have no rights to this house.
you have no rights to this house.
Yeah.
That's exactly right. Yeah.
You're not a legal party to the.
And they want to
ownership
make
of
sure
this
that the
house.
borrower doesn't have another obligation.
Right.
Beyond the one that they've calculated they could qualify for. Right.
Yep.
Yeah. So so what are the things to consider when giving a gift? First of all, the gift itself is not necessarily, well, we said it's not taxable to the receiver, and it's not necessarily taxable to the individual who's making the gift either, because you can give up to a certain amount of money in your lifetime and never have to pay any taxes, gift taxes on that transfer of assets.
You do pay taxes on your acquisition of those, whatever it is you're gifting.
What do you mean? The acquisition.
In other words, you can't take part of your income, say, for example, and gift it, and that would be tax free.
Correct.
Yeah.
Right. Yes. Of course.
Yeah.
Right. So you're paying
So
taxes.
this is post-tax money.
This is money that's already been taxed. You've either earned it or you've invested it and made some gains. Right. Exactly. And so what we're talking about again is gift taxes. Now there is a gift tax, but there's a very high exclusion on those on lifetime gifts.
Yep.
But if the value of any gift to any one person exceeds $15,000, then you have to start filing a return because they want to start accumulating those gifts.
Okay.
Towards your
Because there's
lifetime exemption.
Oh, a lifetime exemption. Oh, I
Correct.
see. Wow. Okay. Yep.
Yeah.
Wow.
Yeah.
Where's that exemption?
It's in the millions.
Yeah.
Yeah. There's a lot. It's a lot. So this wouldn't be for your for your average individual who's just trying to give some money.
So what they're protecting is they're protecting estate taxes.
Great.
Yeah.
Right. So a lot of people have a gift strategy that reduces their estate. So the
Give my kid the house.
the government wants to know if you've given away any gifts during your lifetime, so they can properly compute the estate tax when you die.
Right.
That's really the bottom line. Yeah. So what are some of the things to consider when you give a gift to an individual? Let's say that you are gifting property, as you suggested earlier. Let's say that we're going to give our kids some stocks that we've invested in. We don't want to sell it. We want them to have it. We know they're going to inherit it eventually, so we just give them the stock.
Yep.
Well, there is something important to consider, and that is the ultimate consequence of liquidating those stocks. And again, I've got a chart here, a slide to share. We got it up yet?
Yes, we do. Yeah.
Okay, fine. So the first, I guess the important thing to know is that when you inherit an asset versus you've been gifted an asset, there's a difference in how you're going to recognize or how much gain you're going to recognize when you sell it. And the difference is what's known as the step up in basis.
Right.
Which you've probably heard a lot about as part of the recent debate over taxes and taxing the rich and making sure that nobody gets away with paying no taxes.
Yep.
And this whole concept of a step up in basis. And first of all, to address the debate itself, let me just say that the reason, the principle behind the step up in basis is that we're not going to tax people twice.
Right.
And so if we're going to include the value of the asset, the new value of the asset in your estate for estate tax purposes,
right,
then it's only fair that the people that inherit that asset will have a new basis, what they call a step up. So what happens is when you die and the person inherits that asset, let's say it's stock, then when they go to sell it, their basis is no longer what you paid for it.
Right.
It's the value on the day that you died. You get what they call a step up in basis.
Yep.
By the way, in some cases it can be a step down because it's still going to be the value on the day you die. So if you bought it at 300 and now the price is 100, guess what? The basis in the hands of your beneficiaries is going to be the $100, not the $300.
Right.
So it's generally described as a step up.
Right.
But in some cases, it could actually be a step down. And by the way, this applies not only to stock, but any real assets or any capital assets like real estate, that sort of thing.
Sure.
So
I can see why the tax hawks don't like this.
Yes.
Yeah.
But again,
because it's taking
it's
tax
based
money
on the
out
principle
of
of fairness.
Yeah.
That says that, we're not going to tax this thing twice, because otherwise, if we get rid of the step up in basis, someone could be that value of that asset could be included in the estate for in the total value of your estate for estate tax purposes,
Right.
and then again taxed as income when it's sold by your beneficiaries.
But it also takes a lot of money out of tax range. When you, in most cases,
yes,
it takes a lot of money out of tax range.
Oh yeah, absolutely.
Yeah.
Yeah.
If you bought IBM at $5 back in 1930, and you're passing it along.
Yeah, right. So they describe it as, not ever paying taxes.
Yeah.
Potentially not ever paying taxes on.
Yeah.
So
bought Bitcoin in 2004 or something.
Great example.
Yeah.
Yep. Bitcoin's great example.
Mm.
So just, and I should also mention that if you gift, because we're talking about gifting, if you gift that asset and the person that you've gifted it to sells it later on, well, their basis is the cost or the value or the basis that is the basis of that asset in your hands. So that the basis is transferred to the person that you gift that asset to.
In the case of stocks,
any asset.
Okay.
Any asset that you inherit, cash is going to have a basis of $1.
Right.
Right. So
yeah.
So we're going to talk about money. We're talking about assets that could appreciate in value or appreciated assets.
Yep.
So when you gift something, the basis that you had gets transferred to the person that you gifted it to. So why is that important?
For tax purposes.
Well, it's important because you have to make a decision as the person who has the choice of gifting that asset and what assets to gift. How do you want them to recognize the gain? When potentially are they going to liquidate that particular asset? Do you want that asset, because it's highly appreciated, to be taxed at using your cost basis?
Yeah.
When you could just hang on to it and transfer it to them as part of your estate?
Yeah.
And have them get that step up in basis.
Okay.
Right.
So as an estate transfer, you get the step up in basis. As a gift transfer, you do not.
Correct.
Okay. Huge.
That's the bottom line.
Yeah.
Huge difference.
Huge difference.
Right. So you want to be very careful,
especially on highly appreciated assets like real estate, like
Right. Yeah. And so the example here that I have up, and I probably should have been using this.
I missed that point. So if you do it as part of the estate planning, you get the step up in basis. As you do it as a gift, you don't get the step up in basis.
Right. So the slide shows that if the value, the sale price in this case is $100,000, the basis is $20,000. That's a carryover of the person who owned it and gave it to you.
Right.
So the taxable gain is $80,000.
Yep.
In the case of transfer upon death, you get a step up to the value on the day that person died, potentially zero tax gain, actually potential for a loss. I've seen many cases where, especially in a volatile market, 2000, 2008, where people inherited assets that had, when that individual died, was worth a lot more than when they ultimately sold it. And they can actually recognize the loss for income tax purposes.
That's the king of harvesting losses, right? Potentially the king
potential
harvesting losses.
King for harvesting losses.
Yeah.
Yeah, very good. Yeah. The other thing to consider too for income tax purposes.
So based on a 25% tax rate, that's $20,000 difference between doing it one way or doing the other.
Correct.
To the receiver.
Right.
So this is not small stuff. These are mistakes that can cost you thousands of dollars.
Potentially.
Yeah.
So you want to be careful about how, when you make that decision to gift what you're going to gift, and in some cases it can be a matter of whose tax bracket is better to sell that, right? So you're thinking about giving the stock.
Yep. And
you know what your basis is. You're not planning on dying, but you want to turn that gift into cash.
Mm-hmm.
So you got the stock. You know that's what you want to give, and because you're retired, and your son or daughter is working at the height of their earning
Right.
years
Yep.
in the highest possible tax bracket, you might want to sell it and turn it into cash while you still own it, and then gift the cash.
Yeah.
Value is the value. Up to $15,000, you don't have to report it.
Yep.
Right. So it doesn't matter if it's stock or cash.
So much going on here.
Yeah.
Yeah.
So you might actually want to look at
Yeah.
might want to look at it and say, hey, I'm going to pay less taxes if I sell it than if I give it to them and
Right.
let them liquidate and sell it.
Yeah, we're going to realize more money
Yeah.
if I sell it as opposed to them selling it.
Yeah.
Yeah.
And here's the tip. If you are thinking about gifting to grandchildren for the purposes of college education,
Mhm.
you might want to consider a 529 arrangement in order to make that gift.
Interesting.
Because I said that you're limited to $15,000 per year, unless you're paying for college. If you're paying for college, that's one thing. But if college is, a few years off, and you just want to
Right.
give them that money and let it sit in an account and grow in value, 529 arrangement can be a much better way to do that. The reason is because you can put up to 5 times that $15,000 limit into a 529 account, and it is not considered a reportable gift.
Yeah, but do it in well, see, what's the difference between doing that and the grandchild's name or the parent's name? I mean, when it comes time for FAFSA and stuff like that, for student loans.
So now we're talking about integrating
Yeah.
your planning in such a way
Yeah.
that balances all of the things that you have to
Variables,
all the variables you have to consider. So, okay, we're talking specifically about a grandparent.
Yep.
Who wants to put money away for their grandchild's college education.
Right.
And we're going to use
You put the 529
arrangement
in the child's name.
So here's
or-
here's what we know, that if it's owned by the parents or the student, it's going to be considered the same type of asset. It's going to be considered a parent asset, whether it's owned by the
okay.
the student or the parent, but it is going to be added to the formulas.
Either way.
Either way,
Okay.
it's going to be added to the formulas, but it's going to be considered a parental asset. If it's in grandma or grandpa's name,
Interesting.
it's not
Yeah.
counted in the formulas,
Mhm.
right?
Yep.
So here's a way that you can set up an account, make a gift, get it out of your estate, $75,000 if it's grandma and grandpa together.
Right.
Multiply that times 2, $150,000 into a 529 account, get it out of your estate, considered a completed gift, but not counted in the financial aid
But not
formulas.
affect their financial aid formulas.
However, be careful, because when you pull the money out and you pay for education, then it is considered income to either the parent or the student, which can affect your financial aid.
Oh.
There is a way to work with that
Mhm.
and avoid that negative consequence.
Another new factor here, especially with grandchildren, is that nowadays on certain assets transferring as beneficiaries, that needs to be withdrawn within 10 years, generally speaking.
Say that again?
If a grandchild gets a benefit
Yeah.
from a grandparent,
Yeah.
Generally speaking, they have to distribute that in 10 years now, don't they?
Why?
I thought the new tax rules required.
The 10-year rule that you might be referring to
Mhm.
is a new required minimum distribution for retirement accounts.
Yeah, so a
So if I'm the
retirement account
beneficiary
benefit.
of a retirement account
Right.
today, if I'm a non-spouse, if I'm not the spouse of the person who made me the beneficiary,
Yep.
that I'm inheriting the IRA from,
Yeah, the grandchild.
I'm the grandchild.
Mhm.
This does not apply to 529s.
I know.
Strictly
that-
retirement accounts. Right. There is a new 10-year rule. You don't have to take any money out, but you have to get it all out within 10 years.
Right.
Complicates the planning process.
Yeah.
And dealing
So
with that.
balancing a retirement plan benefit as opposed to a gift That might be one of the
Yeah.
considerations.
Yeah, absolutely.
Yeah.
Yeah, actually, yeah, that's a good point. It is taxable though. Keep in mind, it is taxable to the individual pulls it out. So
Okay.
it's no longer taxed at your tax bracket. It's taxed at the beneficiary's tax bracket. Yeah. So a lot of things to consider
Oh, God,
when
yeah.
when making transfers. Again, something that you probably want to hire a professional and talk to them to see if it's the right thing to do and how to do it in a way that is the most effective.
And can we say, because we've referenced it a couple of times in the show, hire a fiduciary? That's important.
Hire a financial advisor that is subjected to a fiduciary standard of advice.
Right, because someone advising you to move money out of your IRA to a 401k or the other way around is doing it to create a commissionable event in some cases.
In some cases, potentially,
Yeah.
right, and likely not subject to that fiduciary rule. Although there have been, like I said, recent changes in the rules that and regulations that make it more difficult for that advisor to do so without disclosing all of your options, but it still happens.
Yeah, and someone who's independent of a particular product line.
Correct.
Yeah,
Yeah,
always
absolutely.
important to consider.
Yeah. So check out your advisor before you actually hire them.
Mhm.
That would be a good rule. That would be a good rule too. Hey, so I do have today's this week's Talk Money tip, but I do want to take a break before we get to that, and so please stay tuned. We'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. Hey Lou, when the weather gal or guy says it's going to rain, what do you do?
Get an umbrella. Well, actually, I don't, but yeah, that's what I should do.
That's what you should do. Get an umbrella, right?
Yeah, right.
And so we're gonna talk today. Today's or this week's Talk Money tip is about umbrella liability insurance coverage.
Okay.
Right. And so when I talked about this subject with clients, inevitably they say, "Hey, I got great coverage. I got the max $500,000 of liability on my homeowner's insurance. I got $250,500 on my automobile insurance policy. I think I'm pretty well covered.
Why would I spend that extra money?
Why would I consider anything else?
Yep.
Right. Here's the unfortunate thing. First of all, a lot of people don't realize that the $250,000 is not $250,500 is not a range. It's a per person maximum.
Yep.
And a per accident maximum.
Yep.
So
it's a cap.
You get into an auto accident.
Yeah.
And there's 4 or 5 people involved and they're injured.
Mm-hmm.
You're maxed out at $500,000. And the fact is that, we hear awards for bodily injury
right.
In the case of auto accidents, millions of dollars,
sure.
$10, $20 million. And so that's a reason why you might want to consider an umbrella liability insurance policy. First of all, because it gives you excess coverage. over and above the limits of the
Right.
your underlying policies. In fact, most umbrella liability insurers will require that you have these minimum amounts because they have a deductible
Right.
in this policy. And the other thing too is that an umbrella liability insurance policy, beyond giving you excess coverage for all of your liability concerns for bodily injury, property damage, it also gives you coverage that isn't available in the underlying policies. For example, libel.
Oh, yeah.
So if you say something about somebody and they are injured financially,
Yeah.
right? You're not covered under most insurance policies, but with an umbrella liability insurance policy, you do have that. You do have that additional coverage that you wouldn't find anywhere else. And the other thing, and I think probably the most important factor to consider when thinking about purchasing an umbrella liability insurance policy is the fact that your costs for defense, hiring the attorneys that you need in order to defend you, is paid above and beyond the limits of liability on the insurance policy.
Lawyers' fees aren't included.
So they are included in the policy. But what I'm saying is that they're paid in excess of the limit of liability.
Right.
And so first of all, the insurance company wants to make sure that they're not paying out a claim. So you can imagine they're going to hire the best attorneys around to defend you, to make sure that they don't have to they don't have to make a payment.
Mm-hmm.
And those people can cost a lot. And again, all of those fees are paid above the limits of liability. So if you have a $2 million umbrella liability and the settlement is $1 million, $2 million, and the attorney's fees are $500,000, which could easily happen.
Yep.
Then the total payout by the insurance company is $2.5 million. And the way I look at it is this: having that umbrella liability policy is like paying a retainer fee to make sure that you get the best.
Good point.
The best legal defense around in case something does happen.
Yeah, further encouragement for the insurance company to defend you.
Yeah. And so, and the fact is that if you don't have that type of policy and you have the just the underlying limits, even if it's $250,500, people aren't going to sue you for $250,500, especially if they have a legitimate claim for bodily injury, right?
Yep.
So they're gonna sue you for $1 million, and you're only going to have $250,000 in the case of a single individual, and so you're on the hook for the additional $750,000. And guess what? The insurance company is going to send you a letter that says, "Just want you to know, we're going to defend you up to $250,000."
Yep.
And we're going to hire the attorneys that can handle the $250,000.
Yeah.
You might want to hire your own attorney.
Yeah.
To defend you for the excess, and that could run you into thousands of dollars.
Wow.
Right. So having that umbrella liability insurance policy,
I love that. Look at it as a retainer fee.
Not only gives you the protection in case there is a claim and an award, but also gives you the legal defense that you need in order to defend yourself in case they don't have a legitimate claim.
And umbrella insurance is relatively inexpensive.
It is.
Yeah.
But again, if you've got low limits on your underlying policies, your auto and homeowners insurance policy, then
it'll cost more.
It's going to overall the package is going to cost you more because you have to raise those limits on those policies before you can get the umbrella liability insurance policy. More and more, and they're not, although they're inexpensive, they are tough to get.
Oh, are they?
Yeah, if you've got a breed of dog as a pet, it might be impossible to get an umbrella liability. Yeah, if you've got some situations around your house that are particularly unsafe.
So they will vet your situation.
Oh, absolutely.
Yeah.
Yeah.
Because you're basically raising the limits on what they're on the hook for.
Right, exactly.
So they're going to want it to know any potential predilections or problems or things like that.
So they're fairly inexpensive, but they're not easy to get. Let's put it that way. Yeah. But I highly recommend that you do something like that. So that's this week's Talk Money tip.
Nice.
Yeah. So that's looks like we're out of time. So,
but we're back next. No, we're not back next week.
We're not back next week. It's Memorial Day weekend.
Mm-hmm.
So we'll be back the week after that. Not sure what day that is. But in the meantime, if you want to get in touch with me, use the toll-free number, 877-475-2062. Or you can send me an email. It's jeff@talkmoneyradio.com. Or you can send us a message right on the Facebook page. And we do have a no cost, no obligation initial consultation where we can get together, talk about your situation, and determine whether or not it's a good fit, whether or not we can add value to your situation.
Excellent.
So, until next time, remember, good sound advice is much better than advice that just sounds good. Thanks, Lou.
It's a gal.